Hi, everybody. Today we are going to talk about one of my favorite growth companies to talk about in the entire market, and that is Lemonade. Lemonade is an insurance disruptor. They use a proprietary method to underwrite all different kinds of insurance, from homeowners to renters to pet insurance to now car insurance. So, Lemonade has been one of the worst performing stocks in the market in the recent downturn. They peaked at around $180 a share back in January 2021, and they bottomed out at less than one-tenth of that price earlier this year. They've since rebounded a little bit, especially after the most recent earnings report. So let's take a closer look to see if we could figure out why. So the earnings themselves look pretty awful if you're used to evaluating stocks at all. The company generated only about $50 million of revenue in the quarter and lost almost $68 million. So that's a negative net margin of about 130%. So why did they do so well? Well, one, the business is growing. Lemonade's in-force premium was up to $458 million at the end of the second quarter. That's up 54% year over year. The average customer is spending more, 18% more year over year, thanks to the different types of insurance Lemonade's offering. Their core insurance used to be renter's insurance. It still is, but now a lot more customers are buying higher cost types of insurance. Homeowners insurance, a lot are graduating from renters to homeowners, for example. Lemonade now has 1.58 million customers, and they've done that in just over 5 years. So the growth is great. The losses are kind of disturbing, and that's why the stock has been performing so poorly in the recent environment. Lemonade's loss ratio in the second quarter was 86%, meaning that for every dollar it took in for claims, it paid 86 cents out to settle those claims, and that's before its operating expenses. Lemonade targets a 75% loss ratio or less. So you can see they're a little away from where they want to be. And as the business grows, if they don't get that loss ratio under control, it could really start to spiral out of control when it comes to losses. So, what really helped set investors' minds at ease this quarter is that the company really plans to take to acknowledge the current environment and slow down. They used an analogy where if gas is $5 like it recently was, you're not going to put the pedal to the metal. You're going to be a little more conscious on how quickly you're burning through your gas. Same idea here. Lemonade has about $1 billion on its balance sheet, but if it keeps losing $70 million a quarter, it's not going to have that for long. So the company is going to take its foot off the gas a little bit, and the goal is to continue its growth trajectory, which I'll get to in a little bit, without having to raise any more capital. Last time Lemonade raised capital, it was able to sell stock at about 5 times where it is right now. So the goal now is to be able to achieve profitability using just the $1 billion it has on its balance sheet without having to raise any more capital. If it can do that, this could be an absolute home run, and that's why investors are kind of cheering the fact that management is taking steps to make that happen. They also recently acquired Metromile, and it was just a case of great timing. They bought it at the bottom, and it was an all stock deal. Metromile is kind of an AI focused car insurance platform, and Lemonade's just getting into car. It paid $145 million worth of stock for Metromile. In exchange for that, it got $155 million in cash. So it essentially got the company for free. It got $110 million of in-force premium. It instantly made car insurance about 20% of Lemonade's business, up from just 1% now. It got a business with 49 state insurance licenses. Lemonade only has two for auto insurance, and tons of data. That's what Metromile was kind of built around, a data-driven auto insurance platform. So this is definitely a positive. It really should accelerate the company's auto insurance ambitions. But we really need to start seeing a path to profitability. The company gave some good guidance on that. Uh, Most notably, it expects its losses to peak in the current quarter, the third quarter of 2022, and then to kind of start to taper off going forward until it's eventually profitable, and thinks it can do that without burning through all of the cash that's on its balance sheet, so it won't have to raise any capital. It burned through almost $80 million through the first 2 quarters of the year, just to give you an idea of their current cash burn rate. So if they can get that under control, that'd be fantastic. That's obviously the most important thing to watch going forward. You want a company to be sustainable. It doesn't need to be profitable, but it does need to be sustainable. Um, we want to see the improvement in the loss ratio. I mentioned 86% is still a bit high. The company expects, using their proprietary method, a 68% lifetime loss ratio from the new customers that are coming into the system now. And it kind of takes time for these new customers to really settle into where Lemonade thinks they're going to be. Inflation isn't helping the loss ratio. It's somewhat of a forward-looking mechanism, meaning that inflation isn't reflected in the insurance premiums that are being collected for some time because you generally agree to your insurance premiums up front. But when Lemonade has to pay out claims, it's doing so at inflation affected prices. So right now, inflation is straining the loss ratio. Hopefully, that will work itself out in the next couple of quarters. The forward outlook is by far the most important takeaway of earnings and why the stock is rising. This is still not a low risk company by any means. Lemonade has a lot to prove. It's still a very small insurance company in the grand scheme of things. I interviewed CEO Dan Schreiber on a Motley Fool's industry focused podcast not long ago, and he said his goal is to 10x the business and then 10x it again, at which point it would just be a mid-sized insurance company, just to kind of put Lemonade's size in perspective. So it's still an up and comer. It's got a lot to prove. If it can achieve profitability without having to raise capital or without running out of money, it could be an absolute home run for investors. I'd love to know what all of you think. You can leave your comments on this video. I'd love to hear them. This video is sponsored by the Motley Fool. Check out the link in the description to receive the top 10 best stocks to buy now or visit fool.com/Frankel.